The reason that they have that, the SBA, is one kind of slogan is, well, they're the lender of last resort. Well, it's not necessarily the lender of last resort. It's the lender of first opportunity.
Yeah.
And so when you need somebody to take a little bit more risk on you, that's why that program's there.
Huge difference between the SBA and the Federal Reserve.
Yeah. Yeah.
Which is, by the way, the actual lender of last resort.
So they're trying to be the lender of first opportunity.
Brandon Ducharme is an investment advisor representative of and offers investment advisory services through SCF Investment Advisors Incorporated, an SEC-registered investment advisor, 10150 Meanly Drive, first floor, San Diego, California, 92131, 800-955-2517, www.scfsecurities.com. SCF Investment Advisors Incorporated and Ducharme Wealth Management are separate entities. The information in this podcast is current at the time of recording. It is based upon sources and data believed to be accurate and reliable. The information, opinions, and forward-looking statements expressed herein are subject to change without notice. Moreover, all comments and opinions voiced herein are for informational and entertainment purposes only and are not intended to provide specific advice or recommendations and should not be interpreted as such. Further, the opinions expressed are Brandon Ducharme's and his guests and do not reflect the views and opinions of SCF Investment Advisors or any of its affiliates. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what is appropriate for you, consult your financial professional. This information is not intended to be a substitute for specific individualized tax or legal advice. Ducharme Wealth Management and SCF Investment Advisors do not provide legal or tax advice. These services are provided by separate entities. The guest speakers featured in this podcast are not affiliated with SCF Investment Advisors, nor are they affiliated with Ducharme Wealth Management unless otherwise indicated.
What I want to highlight today is commercial lending.
Okay.
I know a couple things about commercial lending. I'm very familiar on residential mortgages. Once you get into commercial lending, I am not an expert by any means. I don't know, and I'm aware that I don't know what I don't know. And I have a lot of people that reach out to me, clients, colleagues, just friends, whatever, and they want to start a business. They're trying to like raise funds, which I don't do, but they, for some reason or another, have a business problem and they need money for the business, right?
Yep.
And what you can do is use personal assets to inject capital into your business, right? And that's what a lot of people do to start their business. And that's easy, right? Like if somebody comes to me and says, hey, I've been starting this business. It's kind of this little side hustle. And if I really had $10,000, it would, I could really jumpstart it or something. And you look at it and you talk with them and you're like, well, dude, you have an $80,000 HELOC line you're not using. Like just you're the whole and complete owner of the business. Just it's your own money, man. Take $10,000 or whatever and, inject the capital into your project or business and roll. Like that's an easy solution, right? But when I get the calls that are, hey, I am sitting on 600 acres of land and I want to start this development, I'm going to need $15 million. That becomes a more difficult conversation. And there's all of a sudden a bunch of things that start to factor in, right? And I get really wild calls. Like sometimes somebody called me the other week looking for funding for an oil and gas project in Texas. I remember I called you about this one, right? And I was like, hey, I'm like, what do I not know about this? And I know enough basic questions to ask, right? And sometimes as like a wealth manager, that's kind of our jobs is to know like what the right questions are to ask to start connecting dots. And then it helps us bring in the right people. And then be aware that we're not the final expert in every single thing. And that's okay. Our job is to help get the ball down the field, not to necessarily be the guy that runs the ball down the field every single time. So, what is, in your opinion, you've been in this space for quite a while. You're well seasoned, helping people with a variety of banking issues. What do you think is the most common avenue that people need funding for small and medium sized business? So I want to like stay away from companies issuing bonds,
Oh,
right? Like in
definitely.
securitization of debt that way. So stay out of investment banking world, just those small to medium sized business, which I think is like, can we define that too? Maybe what is to a banker? And this is probably a better place to start. To a banker, what's a small business and what's a medium sized business?
It has to do with revenue and how much revenue you have. So a small business, you're probably doing $200,000 or less per year in revenue type thing.
Okay.
If I'm just putting a really broad stroke on it.
Yeah.
Medium-sized business, you're at least generating $200,000 a year plus up to maybe $5 million, and then maybe $5 million and up of revenue generated per year. You're kind of in the larger size business.
Okay. And at what point, in my world, those are all micro businesses, right? So like these are the skills within, let's call them
I'm
micros,
sticking
right?
to St. George.
Yeah, right.
Yeah.
So I'm just always thinking, okay, you're dealing with, when I'm looking at the broad market and securities, you're talking about, trillion and billion dollar companies, and right. And so you talk about companies that are a couple $100 million, and that's like your micro caps and your small cap stocks, right? So we're talking about like your local businesses that names you recognize in your community, but they're not publicly traded, large employers per se. So you have like your smaller, so within this kind of small category, you have 200,000, under 200,000, 200,000 to, you said, a
like
couple
5
million. 5 million. Okay. And then you have 5 million up to like, what's the upper bound where you just go, you're probably looking for something like way more in depth than your average local or like regional bank is going to be able to kind of handle or take on. Is that like 100 million in revenue?
Yeah.
Okay.
Probably be above 100 million. You're definitely in that larger market type scenario, which in St. George, I mean, we only have a handful of companies that do more than that.
Yeah. Yeah. You're starting to get like that's in the global picture, that's still small business. But in the macro or regional picture, that's big business, right? So there's always this disconnect, right? Between like, well, I have a medium-sized business. Like, well, what does that mean? Right?
Yeah.
And within what category, right?
Yes.
And not to ever discredit anyone, but I just want to make sure that we're defining out like, who are we talking to about this today? And how can we help those people or not, or, get them the information they're needing. So would you say like most people are probably, it sounds like, are going to fit in that medium-sized business, right?
Yeah.
Especially when they need funding. If you have less than 200,000 in revenue, you probably you either don't need or can't qualify for a lot of funding. Aside from just personally guaranteeing some, kind of more on your own personal credit and assets, right?
Yeah. So let's just start talking about commercial banking kind of from the top type thing.
Cool.
So starting from the top, in the residential mortgage world, you have debt to income.
Okay.
In the commercial lending world, it's called debt service coverage. And it's just the inverse of those things. Rather than debt to income, it's income to debt. And so we're looking for, ideally, we like to see it at a 1.25 or higher. Now, if I said that in a debt to income, that's like a 75% debt to income.
Yep.
So businesses can be more highly leveraged than a like residential household can be. And that's because on that income, you can expense all that out on a business. And then, okay, what do I have left on some of this stuff? So we're always looking for like a 1.2, 1.25 or greater debt service coverage ratio. So making sure we're generating enough income to cover the debts that the business has. So that's kind of when people say, debt service coverage ratio or DSCR, they're just talking about, do we have enough income to cover our debts?
And is that revenue covering debts or net income?
Net income covering.
Covering debts.
Yep.
And the net income on an annual basis. So if you're wanting a 1.25, what you're saying is if you take $100,000 loan out, you're looking for somebody to have a net income of $125,000, right? Now the payments
the payments of $100,000 per year.
Gotcha.
You need to have $125,000 of revenue to cover that.
You want to cover the obligation to make the payments on time.
Yes.
Okay.
Yep.
So if you had a $100,000 loan and after you look at the amortization schedule, let's say it comes out to $25,000 a year in payments, you're looking for somebody to, in order to get that $100,000 loan, they have to have a net income of what is that, 30 $7,500.
Yes. So it's done all off of cash flow.
That's 1.5, but okay.
It's done off of the cash flow. So depending on your amortization, long, short, however much you're borrowing, it comes down to that payment. And then, yes, how much income do we have to cover that payment?
Okay.
So that's the very nuts and bolts of the cash flow side.
Yep.
I've always considered commercial lending to have two sides. You have the cash flow side and you have a collateral side.
Okay.
So with the collateral side, we're saying, hey, what's the value of this? What kind of leverage, is it our policy to be 75% on equipment, or what does that look like? And so the collateral determines how long of a loan I can do. So if it's equipment, then I'm looking at a 5 to 7 year time amortization. Land is typically 15 to 20 year amortization, and commercial real estate, you're typically at a 20 to 25 year amortization. It doesn't follow the mortgage world. It's not a true 30-year amortization. Also with that, the mortgage world gives you, a 30-year fixed rate. Typical commercial lending is not that. Right now with interest rates, you're seeing like a 3-year or a 5-year adjustable rate, meaning it's fixed for those 3 or 5 years, and then it readjusts to market rate, and then it goes for another 3 to 5 years, and it will readjust to market rate. And so the rates are on a much different structure than what like residential mortgage lending is too. So that's worth noting.
Yes, that is, and I could talk for an hour about that and the securitization side of bonds, but no one wants to listen to that. So we'll move on. Okay. So you have, I'm trying to buy stuff for my business. I'm trying to buy basically property, plant, equipment.
Okay.
Right.
Yep.
I'm trying to buy, like, if I'm a construction company trying to buy another excavator.
Yep.
Or I need to buy a warehouse, right? Or a manufacturing facility, or I have a retail business and I want to buy a storefront, right? Or even, and this one's probably harder to pull off for a lot of people, but I have like myself, like if I wanted to buy an office to run my wealth management business out of, and I wanted to own the building instead of being a renter, right? I felt for whatever reason that was a strategically good move for my business long term. Then you can get these commercial loans.
Yep.
For that. And that has its own set of rules, you're saying, for like loan to value on the asset and the viability and collateralization of that. So that becomes a collateralized debt, right?
Yep. And most of what banks do, like 98%, is collateralized. So there's usually always collateral. So let's talk about some of the different classes that you can do within that. Because if you're going out and buying an office space for yourself, then that's owner occupied. So owner occupied always has a smaller percent down than if you're doing like a true investment property. So if you're looking at bank financing and you're looking at buying an office, then that's typically 20% down for regular bank financing. If it's an investment property and you want to go buy it to rent it out to somebody else, you're looking at 75 to 70% financing. So 30 to 25% down on that type of an investment.
And you said how much on owner occupied? Owner
occupied is typically a 20% down. Now, there is another option. It's called the SBA 504 program, and that program typically allows as little as 10% down. So if you are an existing business and it's not a specialty project and you're just growing and buying your own real estate, you could do that with 10% down. If you are a startup company, you can tick on 5%, or if it's a specialty type property, you can tick on another 5%. So that one would go up to 20%, even with the SBA 504. But for most companies, you're an existing company, you're growing, you just need an office, a warehouse, an industrial type building, and those you can commonly do with 10% down.
Now, office buildings, especially like around here, it's usually I'm thinking of a 2 or 3 story building, and let's say there's a couple offices, like a couple suites on each floor. What are the rules around what am I occupying, right? Like, do I just have to occupy one of the suites in that building, or do I have to occupy the whole building? What makes something like owner occupied versus investment? Where's that line kind of drawn? In the residential world, people recently just got in trouble because they were kind of fudging the numbers on that a little bit, right? And originating loans that weren't truly, owner occupied, and they were kind of really more investments. So I always tell people, stay between the ditches, So like where's that line drawn? I imagine there's
typically it's at 50%.
Okay.
Like if you're going for straight bank money, that's typically at 50%. And
Okay.
so if you are occupying 50% and you're renting out 50% of the property, that's about where that line is. With SBA, if you're buying an existing building, then I got to go back. It's like 50 or 60% owner occupied. But if you're doing it on a construction, you have to grow into 80% of that building over a 3-year period.
Okay. So if I want to make sure I got this right. So if I'm building a building and I said, this has, 2 floors and I don't need both floors. Like right away, I only need, the first floor.
Mm-hmm.
And they'll say, okay, well, you can occupy the first floor and the first couple of years you can rent the second floor out.
Yep.
You need to have your business growing so that within 3 years, you're occupying a decent amount of that second floor as well. The end goal on this project is likely to be the sole occupant of the building.
At least up to 80%.
Yeah.
Yeah.
So
if you're doing a construction with the SBA.
With the SBA.
Yep.
How does the funding work on that? You bring money to the table to get stuff going, and there's a bridge loan. Talk to me a little bit about the process. So for construction with SBA,
let's just say the project cost $1 million. I have one right now that's falling almost exactly into this.
That's like a small. And by the way, that's a small.
That is a small, but the math works really easy with $1 million.
Yep, sure. Okay.
So if we have a building that's $1 million, that's my total project cost, my land, my building, everything, $1 million. And I'm an existing company and I'm growing into it. And it's just a regular metal building that I'm putting onto it. And so it's a 10% down requirement. So out of that million, 100,000 is the borrower's injection, or 10%. What ends up happening is the bank makes a interim loan or a loan during construction of 90%. So the bank would do a loan for $900,000 during construction.
Okay.
After construction is complete, the SBA 504 steps in and they will do a 40% loan amount in a second lien position. So what happens is the bank takes a $500,000 lien in first lien position, and then the SBA does a $400,000 lien in second lien position. And so you have a total of 90% financing. The bank's in a first with 50%. The SBA's behind the bank at a 40%. And what that allows to do is it allows the bank to take on some more risk with these borrowers, because the bank doesn't want to be over leveraged or too much risk. But when you have this program, the bank gets to go in first lien position at 50%. That's pretty secure. Owner occupied.
And so the reason why, just to clarify here, is if your business fails and you totally default and you foreclose.
Yep.
As long as the property's still worth more than $500,000, the bank's going to be able to foreclose on it. Tell the SBA, sorry, you don't get your money, but we're going to resell this property, and as long as we get our $500,000, we're going to be made whole. So it'll be okay. I actually just went to an auction at the courthouse a couple weeks ago this was residential, but it's kind of applies. There was a home that foreclosed, and they had a primary mortgage, first lien. They had a second bank that had a second mortgage in second position, and then they had a slew of judgments on the property.
Okay.
Right. Or judgments against them that put liens on the property. And the first bank obviously is the one foreclosing. I'll just say very large national bank. Obviously they're not there. The county's kind of doing the auction. And then there's quietly this very interesting guy to talk to. Talked to him for a while after. He's an attorney, and he was there actually representing the second bank, right? The second lien position.
Yep.
So the first lien on this home was, like $300,000 or $400,000. Second lien, the second mortgage, was another $400,000 or $500,000, and the home was really worth, as is right now, maybe just over $1 million.
Okay.
Right? And so they start the bidding, and they say, we're going to sell this home for, and I think they started at like $352 or something, right? Like whatever, like the first, basically like whatever the first mortgage was, that's what they start the bidding at. And, so somebody says, $365, and, then here's this kind of quiet guy. Yeah. $366, and everyone's like, $375. You know what I mean? It's like $1 million house, isn't? So people are just like, let's not waste the time. $375. This guy quietly, $376, and they end up, and people start getting like almost like frustrated. And I think they just didn't realize at all that he was there to represent the second lien holder, and he had to come in as the second mortgage holder. In this case, another bank had to come in and buy it at foreclosure to protect their interests as in the second position. And so they stepped in and actually made the first bank whole. They were the ones holding more risk. The second lien position was holding more risk.
Absolutely.
And that's what mitigated the risk of the first borrower. So if you in my opinion, if I was in first position on a property, low loan to value, and I could be in first position and they're going to come out with a great lending institution that's going to be able to backstop all this, you're almost de-risking your deal because now you have two people that are willing to make sure that you get money on this property. And that's what the SBA does for these commercial projects, right?
Correct.
Is they make it so that way, if something happens with your business, they're telling the bank, hey, it's okay to borrow these guys money, even though they are not well established. Their business model maybe has high competition. They don't have an economic moat. They don't have, for all these reasons that if they were trying to issue a bond, a securitized bond in the broad market through investment banking, it would be a not rated, horrible bond in, when we talk about junk bonds, right? and it's just, this local guy trying to run a, good business in town or whatever, right?
Yep.
And so SBA, this government program saying, hey, bank, borrow them the money. We'll take the second position. So that if something happens, we're going to step in and really, in order to protect their own interests, because that $1 million building probably isn't going to decrease in value to $500,000. That'd be a huge drawdown on real estate.
Yes.
What they're anticipating is that building being at least worth, $750,000, $800,000, and the SBA almost has to come in if it were to foreclose and buy the whole thing at that amount, giving the bank back all their money to just protect their interests so they don't lose the rest of what they had because they could go sell it. It's a risk management play.
Yes.
Anyways,
and that's what it is. So, and that's why the banks like them, because you know that you're in a good, secure position.
Yes, very secure. And that
even
was really
if it's a little
long-winded.
risky, even if the business is a little riskier, a little bit more risk than the bank would like to normally take on.
Yeah. Yeah. So you have an asset that backs it. And then even that asset, the way that it's financed and backed is kind of an additional layer. So it's not just, collateralized, but you kind of have a good partner. It's almost like, you watch Shark Tank at all?
Yes. I love Shark Tank.
Yeah. We love Shark Tank in our family. I think a lot of it is just for show and scripted, but it's still a great show. But you ever see the deals where, like a shark's kind of on the edge and they're like, like there's so much potential here. And I kind of want to do this deal. And they're like, hey, what if we did 2 sharks?
Yeah. Come in with me.
Yeah. Come in with me. So I don't want to put 200,000 in for 10% equity. I want to put 100,000 in for 5%. And I want another shark. And the reason they do that is it's not because they didn't have the 200 grand or something, but it's like because they know if they have another good partner, now they have 2 kind of good forces behind the scene that can really try to help this thing fire off, right? Mm-hmm. It's kind of like that's what a bank's doing with the SBA. Like, I want to loan people money. Can we bring someone else in and together we'll loan you the money? And now I feel really good about the deal.
Yes, absolutely. It's a risk mitigant. And that same thought process that you just said, that is what the SBA 7A loan program is. A lot of people hear SBA 7A have no idea what that means. Let me just kind of put that into some little bite-sized pieces. So what they do is the SBA 7A has some different programs. There's Express and their 7A program, which what they do is they issue a guarantee, either a 50%, 75%, 80%. There's different percents depending on the exact loan program. But what they do is they take those same like risky businesses and say, now there's no real estate involved. So we don't have the real estate. We're just looking at some equipment or purchasing an existing business. And so how do we finance that? What the SBA does is, let's just use, for example, a 75% guarantee. So the SBA will give the bank a 75% guarantee on that loan. And what it is it's a 75% guarantee of the loss. Mm-hmm. And so if you do a $100,000 loan, and let's say after everything's been foreclosed and liquidated, there was $50,000 worth of recovery. And so the bank is looking at a $50,000 loss, and it had a 75% guarantee on that. Now the SBA will come in, step in and pay 75% of that, which is Why is my brain going blank on the math? It's
$12,500.
so yes, $12,500 will be the loss, but they will cover the addition, the difference.
$37,500.
Yes, that's how much they will cover. So the SBA will write a check for that $37,500 to the bank, and then the bank has that $12,500 loss. And so the SBA program steps in and guarantees a percentage of the loss. Now, if there wasn't a loss, then they don't have to step in and do anything. The bigger the loss, the bigger the check, to the bank. But they do that so that the banks will take on some more risk. It's a risk management tool that they can use.
Yeah. And I could go for hours on how government programs affect all of this. And, there's no such thing as a free lunch. We all pay for these costs. So you might as well use it, right? Like, don't be scared of FCBAs is my thought. It's my own personal opinion. If it makes sense, take advantage of it. I think a big misconception though is I'm glad that you clarified that. People think, like private mortgage insurance is kind of same way. SBA loans, like, oh, well, they're going to come in and make the bank whole as long as, the loss isn't too big. Now it's just however much they're going to manage how much the bank can lose, but there's not a scenario in which they say, well, we'll make the bank whole.
Correct.
Right. That's what insurance is for. And banks are sophisticated. And if they really want to manage their risk against portfolios that way, I'm sure that they can do it with the capital markets. I don't want to get too complex in that. But there's ways to do that. And that's what we saw a lot of people doing in 08 on the winning side of 08, not the people that lost their shorts, the people that utilized advanced instruments to manage the risk of their portfolios overall.
Yep.
Okay. How much revenue does a business need to be producing in order to get one of those, what was it, 7As?
7A loans. So that follows kind of that same 1.25. That one's based on the cash flow.
Okay.
Those ones are typically undersecured. And if they're undersecured, what they do is they look at the individual and they look at the project. So both the business and the individual, and they say, oh my gosh, where is any collateral that we can take? Is it in a car? Is it in the house? Is it in some other equipment? And they'll put a lien on any additional collateral that there is. So for example, you're trying to get a business loan. There is no equity. There's no collateral in this. It's a service-based business, and you have equity in your home. The SBA can take a lien on your home to secure that home as collateral in case there is a loss somewhere. But rather than trying to figure out, yes, where all this collateral is coming from, the reason that they have that, the SBA is, one kind of slogan is, well, they're the lender of last resort. Well, it's not necessarily the lender of last resort. It's the lender of first opportunity.
Yeah.
And so when you need somebody to take a little bit more risk on you, that's why that program's there.
Huge difference between the SBA and the Federal Reserve.
Yeah. Yeah.
Which is, by the way, the actual lender of last resort.
So they're trying to be the lender of first opportunity. So
Ed, help me understand what they really mean by that.
So because you're starting a business, you don't have the cash flow, you don't have the collateral, banks don't want to lend to you. It's just the bottom line truth. That's too hard. That's too much risk for a bank to take on.
Yeah.
There's kind of the saying out there that, oh, a bank will only lend to you and you don't need the money. Well, a bank likes to be proven that they can be paid back.
Yeah.
If the borrower can't prove that they can pay the bank back, yeah, the bank's not really going to sign up for that debt.
Well, that's the whole difference between like debt and equity. Right. And that's where people forget when people have to sell shares in their company. Equity financing is oftentimes significantly more expensive than debt. Right. Like that. And that's why what's interesting about Shark Tank, which people can learn great lessons from watching this show.
Yes.
But the cost of capital in a business is significantly higher on the equity side. So if you're let's just as an example, I haven't looked into this company recently in any specific capacity. Totally an example. Apple, though, just so that people can kind of relate. Which they just bought back a ton of shares. But if they needed more money, which they don't, but if they did, they can go and issue a bond, which is debt. To them, that's like going to the bank and saying, "Hey, we need for them, they're like, we're going to need a couple $100 million. Right. But they're like, hey, we
Chump
need
change for them.
Yeah, we need some money to build a plant, run operations, do R&D on this, whatever it is. Or they can go to the market and issue more shares in the company, right? And sell them at, X dollars per share when they issue them, and investors buy them, and the company gets that money, and now they can use that money just like if they gotten a loan from the bank and run operations, right? If you intend on going out of business, equity is cheaper, right? Like,
Oh, yeah.
because you never have to pay it back. But that's why if you have a really good business, but there is nothing to prove there, they're saying, well, the bank won't lend me money. And you're saying, well, it's because we want it proven. We want to know that if we don't get the same upside potential, that if this goes well and blows up, we make a bunch of money, right? You just have to pay us the money back at whatever, 6 or 7 or 8% interest or whatever it is.
Yep.
And that's very unappealing. So in order to only have that kind of limited return, they want limited risk.
Yep.
And so equity financing is when you sell equity in a business. People are looking to say like, yeah, I believe in you and I do believe you. I think this is going to go great. Except I'm not looking for a 6% return. I want equity because I want that 100%. I want this thing to moonshot. I want that. I want this business to absolutely blow up, and then I'm going to go sell my shares.
And that's why they have Shark Tank, is because it's not quite bankable yet, and you need to get the equity. So they're all there for the equity piece.
And that's why you don't see a lot of people saying, so sometimes they come in and they say, well, we'll buy some equity. We'll also issue you some debt or give you a line of credit or something, right? Like they'll be that partner, but there's always that equity component. It's very uncommon that in it, an investor, which a bank is nothing more than a form of an investor, right? Says, yeah, hey, I'll issue you the debt and not take the equity when there's a lot of risk.
Yep.
So yeah, equity versus debt financing.
Yes. Well, I mean, people bring that up, and it is a good point to bring up in commercial financing, because you have a startup business. You can go get your equity partners and inject capital that way. You can go to the bank and see what you can do that way. The bank, once you've repaid the bank's out of your hair, and that pot of gold ideally fills up. Whereas equity partners are all dipping into that pot of gold. Forever. So that's,
Yep. You got to buy the equity back at some point if you want. So, there's entire classes on, and I took one in college on basically how a company funds, right? And looking at the cost of equity versus the cost of debt and how companies kind of make that decision. Way different on a huge company scale versus like a little company. But generally speaking, just think about it. Like when you go to the bank and you want a bunch of money, like if you want, in a past life, I worked with a lot of contractors, land surveyors, and excavation companies, right, in the development space. One of those excavation, like a cat excavator, is like hundreds of thousands of dollars. Like people drive around St. George and they see them all over the place. Like that is more expensive than any car you'll ever drive in your life.
Yes.
Right.
Yes.
And and it's some 20-year-old kid out there, pulling the lever, swinging this thing around. It's like, hundreds of thousands of dollars. So you can't just go to the bank and say, hey, I know how to operate a machine. Grew up doing this, or I've been doing this for years. I know how to operate one, and I know I can go. There's not a shortage of work in St. George to have this type of business. Can you just borrow me $500,000 so I can go buy a new cat and a truck to tow it and whatever, and I'm going to be in business? They're going to go, no way. But what you might be able to find is somebody that says, hey, I believe in you, kid. I'll go in with you. You do all the work. I'll bring some capital. That's an equity partner. Now, once you're operating, if everything's going great and you go back to the bank and you say, hey, I have jobs lined up. I have cash coming in. I have more work than I can handle. I have employees. I need to buy another machine. The bank is now interested in that conversation.
Correct.
Because they're like, hey, there's something here.
There's proven cash flow. It's more than just, I think this is going to work.
Right. Yep. So banks are looking for less risk. They're debt partners. They're not equity partners.
Correct.
Equity partner from a bank is their worst nightmare. They do not want to be your equity partner.
No.
That's
we're just here to collect our money and go home.
That's bad, right? So anyways, okay. So seven A's can be used service-based business. What kind of down payment, or like, is there a down payment that kind of comes with that, or loan to value, or is it really just based on collateralization of assets that they do have that can cross collateralize?
So it does come down to like a minimum payment, which is typically in the 10 to 20% range.
Okay.
Everyone kind of is a little different. You'll need to just go in and talk to your banker and dial that in. But that one, when you use the 7A, it's not just 100% collateral value. It does go off of the cash flow, and we've taken all available collateral. So it allows for some more risk that way. The bank is going to look at it. So say you're buying your excavator, and you know those two scenarios you did, and the one's hopes and dreams, and it's like, okay, you can look at the SBA 7A to begin with and see where that goes. But once you have that proven cash flow and it's more of a bankable deal, you might not need the SBA 7A. You can just go into your bank and they'll look at, okay, we have cash flow now, and I have collateral loan to value because you have a down payment. It just qualifies for regular financing.
And okay, one of the things that I think I caught there is when you do a 7A, they have to collateralize all available assets.
Correct.
So if you have a car that's free and clear, or a trailer, or investment account, or your home, like a home equity,
Your home.
they're going to lean, in order to get a 7A in any capacity, right? They have to collateralize all that stuff, everything you got.
Yes, they will look at that and they will say, okay, we've got to take everything you've got, because if you default on us and don't pay us back, we're going to try taking everything we can to make,
What if the
whole.
7A is like less than the equity? Like if you have $1 million equity in the house and you're trying to get a $200,000 7A,
So
are they going to just, like, will they leave your truck alone at that point, all this stuff? Or do they say, like, nope, everything you has gets leaned with 7A?
because they're just trying to make sure, like, if you're after a $500,000 loan, that
So they want to collateralize 100% of it.
Yes, of your loan amount.
Yes, of your loan
So
amount. Yep.
if you're going, that's not a blanket statement. No matter what you have and what loan amount, they're going to take everything. No,
Sure.
they're just trying to cover enough for their loan.
But I think that the thing to highlight is if you do a 7A, you're personally guaranteeing this.
Oh, yes, absolutely.
Like,
but on almost all business loans, you are. There's very few out there that don't have a personal guarantee behind it. Very few, to be honest with you.
In this like sort of small
Yes.
business.
So if we're talking businesses in
like
our
local
area,
business. Yeah, like local. I'm going to call them like local business, or maybe even regional businesses.
Yep.
Okay. So once you get past that 100 million in revenue, maybe there's not a personal guarantee on stuff.
Then that's where you go into some specialty type lending, and yes, they have more options.
Okay. But otherwise, most stuff, there's someone's got to sign somewhere.
Yep.
Okay. I think on smaller stuff, it's easier to get, correct me if I'm wrong here. On smaller stuff, it's easier to get business financing without a personal guarantee. Like if you're talking about, if you're the $50 million a year business and you're trying to, get some small financing on a, used pickup truck to run around town, or like I've heard of, lines of credit, like credit cards or something like that, don't necessarily need a personal guarantee.
Yeah. So sometimes with the credit cards, the credit cards.
Some stuff on that end, but.
And once you're really large, once you're a large company, but when you're small or starting off or cash flow's tight, do not count on not signing a guarantee. It's going to be there. You're going to need to sign it.
Yep. So your personal credit matters and will be impacted.
Yes.
Okay.
Yep.
Which is sometimes for entrepreneurs really affects their ability to be homeowners and how they do and navigate all that. So I always encourage people, like, have a plan. If you're a business owner, like, tie your whole plan together, your business plan and your personal plan. They should be like distinctly separate, but you should see where that bridge between them is, so that they can kind of come together to move the ball down the field in its entirety, and not, your personal life's great and your business is falling apart, or your business is great and your personal is falling apart, or everything's great, now the business, goes wrong and your whole life comes apart. You want to try to manage the whole thing, right? Correct.
This is making me think of how self-employed people file their tax returns, because a lot of people are looking to write off everything they can and minimize their tax liability, which, hey, my husband's been self-employed forever. I get that.
Yeah.
However, when you go in to qualify for a loan, the only thing we can underwrite on are those tax returns. Mm-hmm. And so if you've written off absolutely everything, you're not leaving yourself very many options.
Yeah. It is a double-edged sword.
Mm-hmm.
So I am a proponent for paying the least amount of taxes legally available. But be honest with yourself that if you write your income down, where you're like, this is what always cracks me up. Okay. People say that this is the phrase, and I'm sure you've heard it. Well, we don't show any income on our taxes. Mm-hmm. No, you don't make any money. Mm-hmm. That's
the reality.
That's what you just said.
Yeah.
Is you don't make any money. You make gross revenue, but revenue is vanity, profit is sanity, and cash is king. Mm-hmm. Right. So if you get to the end of the year and you don't have any cash, and now on your taxes you're showing no net profit, dude, you didn't make any money.
You put yourself in a hole.
You put yourself in a hole, and like, yeah, maybe you're robbing your business of funds to, pay for personal expenses, or which realistically, that's oftentimes what they are, is personal expenses that are being justified as business expenses. Mm-hmm. But all you're telling me is like your business is not actually running efficiently, and it's not the cash cow.
It doesn't make money.
It is. Yeah, it doesn't. It doesn't make profit.
Correct. Profit.
Make revenue. And there's a huge difference between revenue and profit.
Yes.
You have to be able to get, so I tell people, if you today measure your business in terms of gross profit or sales or revenue, right? And there's a difference between revenue and gross profit. But if you're looking at those top line numbers, right, and that's how you measure, you need to start transition to net profit. Mm-hmm. And if you're at net profit today, okay, and you want to become wealthy, you have to start transitioning to net worth, because net profit doesn't even really matter that much anyways. Like year over year, it matters what you do with it once you have net profit. Mm-hmm. Okay. So you got to start building net worth. That's my thing. Some people don't care and they want to focus on whatever they want to focus on. Whatever. Those people aren't my clients. But what you're saying is if somebody comes in and you could be doing 200,000 or 200, you could be doing $2 million a year in sales. Mm-hmm. But if your net profit is 50 grand or 100 grand, there's not a lot that if you need to expand operations or you want to buy that commercial building because you think it's a great long-term investment, you just can't do it.
Correct.
And then you're going to have to go through a couple of years of maybe paying more taxes just so that you can get income on paper to then qualify.
Yep.
Yeah.
Set yourself up for success.
It's the same challenge business owners have when they go to buy a home.
Yep.
Mm-hmm. They have the same problem with mortgages all the time. And the ones that do make a lot of money, there's unique lending products out there, that they can get, with different bank statement loans or this or that, right? It's just, but it does become more complex. And a lot of that too is just a lack of tax planning.
Yeah.
Because there is, maybe this is a decent question. When an entrepreneur is going to qualify for a home, and I'm not a mortgage underwriter, so I could get this wrong. It's totally disclosure here. Mm-hmm. If you were going to buy just a residential home, you're a business owner, and you aren't showing a lot of income, but it's because a lot of that is like depreciation that you're taking on assets that you do own, right? Yep. So within your business, you took a bunch of depreciation on machinery you own or vehicles or whatever. It's not expenses, it's depreciation, right? There is an asset there. They can take that sort of income that you wrote off on the business return and add it back into your income. And this is a little bit of tax speak, but on your 1040, right? Like on your AG on the personal side, they can say, hey, we're going to add that depreciation that you took on the business here as an expense. You sort of expense the depreciation or claimed it. Right. We'll add it back in. So you are saying you only made $40,000 when you go to the IRS and say, this is what I owe taxes on. But this $100,000 depreciation wasn't an expense. You didn't spend that money. Correct. That you had spent that money, and now you're depreciating the asset down. So now you're realizing it as essentially a loss on the taxes. But because you didn't physically you didn't swipe the card for $100,000 of expense that just walked out the door. Now we'll add that back on. So now your actual AGI or adjusted gross income is $140,000 in the eyes of the underwriter, essentially. Mm-hmm. Does it work the same way when you're trying to get business loans?
Yes. So absolutely on the commercial side. I'm like, I can't really speak to the residential side,
Sure.
but the commercial side, yes, because what we're also looking at on the commercial side is actual cash flow. So versus just taxable income is your true cash flow.
Okay.
And where is this money and where is it coming from and what cash flow is available to service debt? And because that depreciation is kind of a paper loss, it's a paper write-off for your tax purposes, but you didn't really abstain that loss, then yes, we do add the depreciation back in. And so it's kind of your net income plus that depreciation. So you do get to add that back in.
Yeah. How do you substantiate cash flow? When you go into the bank and you say, hey, I'm trying to get a loan, how do you substantiate your cash flow?
So usually what you do is you can go in and you can say, okay, this is my net revenue plus your depreciation plus any interest expense, because that is money that's available to service debt. And then we look at what debt payments do you have. So how, auto, equipment, building, anything like that. And then we also look at distributions and where do the distributions, how much money did you pull out of this business? Did you leave it in the business or did you pull it all out of the business? Which brings you kind of to retained earnings and what have you left in this business, or do you drain everything out all the time? Ideally, banks like to see that you leave something in that business and that business is growing. But like, for example, the medical field, a lot of the medical field will take, doctors will take and distribute everything out at the end of the year and say, hey, I'm taking all of this that I've built up over the year and I'm distributing it out. So it moves that money or that equity kind of position from the business to them personally. And that does shift the way that you underwrite things. So sometimes it's an issue, sometimes it's okay. But if I'm throwing 2 cents out there, it's leave a little bit in that company. Don't pull everything out and drain it completely dry. Our favorite companies are those that leave it in the company and have that grow. When you're lending to that business, it makes a difference. How much assets, if I'm looking at the balance sheet of that business, how much have they left in there? Or do they drain it every year?
You're saying even though it's a pass-through entity, right? It's an LLC or, maybe a partnership or whatever, right? Like a lot of people that are self-employed have even just personal S corps, right? And what you're saying is on the taxes, all the income flows through to your personal tax return. However, physically, and I'm using the word physically.
Yeah. The true cash flow.
But digitally.
Yeah.
What you're saying is don't transfer the money out of your business bank account to your personal bank account. Leave it in your business bank account. If it's to be used for business purposes down the road anyways, just leave it in there. Your bookkeeper will probably thank you. Which is interesting. I used to hear people all the time say, well, I'm not taking money out of my business. I leave it in my business. And it was this weird thing after the Tax Cuts and Jobs Act, because the corporate income tax became so much lower. And they're like, yeah, so I leave it in my business and I pay less tax. I'm like, no, that's not how it works. It flows the on paper, the income will flow regardless. You can't gate that or dam that up, right? But from an underwriter's perspective, you can. It's kind of what you're saying is hey, we kind of pay attention when we do the underwriting on this. How much are you taking out of the business to then go do whatever you want with it on your personal life, which we don't care what you do with it over there, but we can't account for it then. Versus, oh, you're coming and telling us that you need money, but every month there's a surplus of money that just accumulates in this account and there's plenty of reserves. And obviously that means you don't need it in your personal life. So we can expect as underwriters that after we issue this loan, something isn't going to drastically change. You're going to change your habits and just say, well, I'm taking all the money out now every month and now there's nothing to service this debt with, right?
Yeah.
And
it's different when you look at different partnerships. If you have a business and there's 4 different partners in there and, all 4 of them drain it out every year and takes the business down. But if I'm lending to that business and that business is my primary borrower, I'm looking to that business first and foremost for my source of repayment. And so if I see that they draw everything out of it every single year and there's nothing left in there, if I come to a repossession type situation, there's not much in that company. They keep taking it all out. And so if you leave at least a little bit in there, it helps pad that and make it a stronger loan. So that can help strengthen your position when you're trying to get some funds.
Cherry on top for the underwriters.
Yeah.
So, okay. One last thing I want to cover is being prepared to go and talk to a banker.
Okay.
I think a lot of people are intimidated by the process. A lot of people don't have, with the rise of credit unions and their efficiency around consumer lending, A lot of people don't have relationships with regional banks the same way that they used to, especially business owners. So as you start kind of being that business that you're going to need some funding, you may want to establish a relationship with some regional banks or a bank that you like or something like that, because they're probably going to be your primary lending partners as you kind of grow as that small and medium-sized business. But what does somebody prepare to bring in? Like, what do you need? P&Ls, tax returns, bank statements on personal stuff. Like, my theory always, when you're going to get a loan, make it as easy as possible for them to say yes, right? Like if you go in and you're like, I have this idea, right? And I have nothing organized. They're like, hey, you're starting on you're starting behind the ball a little bit.
Mm-hmm.
But if you're like, hey, here's what I need money for. I know exactly what I'm doing here.
Yep.
And here's my, like I would call it a loan packet maybe.
Yep.
Here's my last 2 years tax returns. And here's everything that you will need to just, look through this today and say yes. What does that look like when somebody brings the right stuff to you guys and is able to help streamline that process?
So because we're looking at the cash flow, and cash flow is one, side that we're looking at. So yeah, past 2 years, business and personal tax returns. And then we like to see the profit and loss and balance sheet that go with those business tax returns for those years as well. That gives us kind of the full financial picture of what we're looking at that way. And then yes, what are we using the money for? Do you have a down payment, and what kind of loan to value are we in? Those are some really simple things that we're trying to analyze just right away. Mm-hmm. What's my cash flow situation? What's my loan to value situation? So the sooner we can kind of draw a clear picture there, that is best. However, I will say if you go into a bank and you're intimidated by that process or you don't know what questions to ask, you just go in, start the conversation. They will talk to you. They'll say, hey, we need this. For a lot of my conversations, it's like, hey, Shannon, we're getting ready to go and we're getting ready to do this. And I say, okay, great. I'll send you a needs list. And it's a list of all the things that I need. Hey, send me these things and you can piecemeal it to me or send it all together or however you'd like. Those that send it all together are definitely our favorites because that helps us with some follow-up. Mm-hmm. But send us all that information and we'll get going on it. And so whether they are intimidated to come in, if they have all their ducks in a row, fantastic. If not, come in and just start the conversation anyway, and we'll tell you what you need. Okay.
So if somebody's looking at getting a loan, and they think they're here in Utah, because you're here in Utah, they think they want to ask you some questions, get some more information. What's the easiest way for somebody to get a hold of you, Shannon?
Probably just call me on my cell phone, 435-632-9655.
All right. Personal cell phone right there.
That's
direct access.
Yes.
That is some quality customer service these days out of the banking world. So cool. All right. Well, that's a lot of information. If someone's still listening, good luck digesting all of this.
Thanks for sticking with us. Yeah.
The financial world is not known for being simple. But if you can learn to navigate it, it really works in your best interest.
Yeah. Yeah. We're here to help.
So cool. All right. Thanks, Shannon.
Okay.
We'll look forward to talking to you again soon.
Thanks for having me.
Investing in real estate and securitized real estate may not be suitable for all investors and may involve special risks such as limited liquidity and demand for real property. Changes in supply and demand for real property, change in law, tenant turnover or defaults, loss of investment, competition, casualty losses, use of leverage. Real estate values may fluctuate based on economic, environmental, and other factors. There is no assurance that the investment objectives of any real estate program will be attained. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than the original cost. Asset allocation and diversification are approaches to help manage investment risk. Asset allocation and diversification do not guarantee against investment loss. Past performance does not guarantee future results.